Good afternoon and welcome to Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Amy Torget and I'll be your host today for today's presentation. As many of you know, the Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Each presentation is recorded and available from CBay through YouTube and on the Yale iTunes U channel. Today, we are talking about blended finance, what funding gaps it fills, how it can be applied to drive environmental restoration, and lessons learned from the field. Here to talk about her firsthand work in the field is Elizabeth Teague of Root Capital. Elizabeth serves as the Social and Environmental Performance Manager for Root Capital. She manages the social and environmental due diligence of Root Capital's loan portfolio, oversees environmental impact evaluation, and leads program innovation related to climate action. She holds a BA from Dartmouth College. During the presentation, Elizabeth will discuss Root Capital's work using blended finance to aid the renovation of smallholder coffee farms. She will touch on a case study to illustrate why a blend of capital is needed, how specifically it can be applied, and the lessons learned thus far. Today, we're excited to use a new format for the webinar. We have a shorter presentation than usual from Elizabeth, about 15 to 20 minutes, which will allow ample time for Q&A and discussion. We really want to foster a good two-way dialogue between Elizabeth and you, the audience. So please make sure to submit all your questions and we can have an in-depth discussion with Elizabeth about all the areas of Root Capital's model you're most interested in. You can type your questions in the Q&A section of your screen throughout the presentation. We will collect them and I will present them to Elizabeth at the end of the presentation. All right, let's get started. Elizabeth?
Great, thank you so much for Amy for the introduction and also for the opportunity to participate in this webinar series. I appreciate it. So as Amy mentioned, today I'm going to speak to Root Capital's experience designing loan products for the renovation or replanting of smallholder coffee farms with benefits for farmers and the agroforestry farms and broader landscapes on which they work. So first I'll provide a quick introduction to Root Capital. Root Capital is a social lender that provides credit and business training to agricultural enterprises in Africa, Asia, and Latin America. I use the term social lender because we seek to use finance to improve the livelihoods of marginalized rural farmers. We found that the most effective way to grow farmer prosperity is through the businesses that collect, process, and market their crops. Businesses like coffee cooperatives in Guatemala or macadamia nut processors in Kenya or cocoa cooperatives in Peru. We found that these businesses really act as engines of impact in their communities, raising incomes, creating jobs, and preserving ecosystems. But these businesses themselves are often under-resourced. They're locked out of commercial financial markets that see them as too unprofitable or too risky to serve. So Root supplies agricultural businesses with what they need to grow and succeed: access to capital through our loan products and business skills through our advisory arm. And I'll talk about each of these in turn. So on the lending side, Root specializes in two loan products: short-term working capital, first short-term working capital tailored to the agricultural cycle. Loans that help solve liquidity issues during the crunch period between when a business collects a crop and receives payment from its buyers. We also provide some longer-term capital expenditure loans for investments in equipment like processing machinery or infrastructure. And just to give you a sense of numbers, a sense of scale of our lending operations, last year we dispersed $120 million with an average active loan size of $400,000. Our average borrower had around $4 million in revenues and worked with around 2,000 smallholder farmers. Most of our loans, around 70%, address credit needs not met by commercial financial institutions in these areas. On the advisory side, over the years, we've developed an in-house arm to answer some of the capacity challenges that we've seen in our portfolio. So we provide training on a number of business capacities with a focus on financial management skills like accounting and cash flow management. Some of the deficits that can really prevent a business from fully taking advantage of our capital and from growing. We provide these services to a subset of current and potential borrowers each year. to strengthen the capacity of current clients and to mitigate some of our risk as a lender, and to build our pipeline of new clients that are eligible for our financing. Just a note on our capital structure. So Root Capital is structured as a nonprofit. We're registered as a nonprofit here in Massachusetts, which is where I'm speaking from today. But we work internationally, and we deploy mostly private capital. So about 76% of our 82 million in lending capital comes from individual and institutional investors, some of which you can see here, and the remainder from public sources, primarily the US government. We manage our investment capital on our own balance sheet, and we on-lend it to borrowers around the world. And finally, before going into the case study, just a note on our performance to date since our founding in 1999. As of the end of Q3 of last year, we've dispersed over $1.2 billion to over 660 businesses, reaching over 1.2 million farmers. Great. So for this group today, I wanted to focus on a specific application of our model: credit and advisory for the renovation or replanting of smallholder coffee farms, which we see as very important because there are benefits both for the farmers in terms of improved livelihoods and for the agroforestry landscapes in which they work, which may be particularly interesting to this audience. So first, let's talk about coffee. I think we all know coffee, the drink. Let's talk about it as a plant. So coffee is a type of tree. It's native to tropical rainforests, and it can live for a half-century or more in a shaded environment, although it only produces coffee beans at any commercial scale for about 15 to 20 years. Oops, sorry. Beyond providing the world with its caffeine fix, coffee provides a livelihood for roughly 25 million farmers in Africa, Asia, and Latin America. Most of these farmers are smallholders, farming on less than 5 hectares of land, or around 12 acres. And most live in poverty, or in some cases, extreme poverty. Most of these farmers grow coffee in or around critical biodiversity hotspots as well, defined by Conservation International as landscapes with exceptional concentrations of native biodiversity. These hotspots are generally forest landscapes, such as the tropical Andes in Peru or the looser ecosystem in Indonesia. And they face significant threats from development, including small and large-scale agriculture. Luckily, coffee is different from many other crops, particularly other commodity crops, in terms of its potential to counter some of these threats. Again, coffee is a tree that grows best in forest-like environments. This is particularly true of the high-quality Arabica variety used by specialty companies like Starbucks. As a result, many farmers grow coffee in agroforestry systems, which are farm systems that incorporate shade trees or fruit trees into a natural or managed forest landscape. You can see some examples of agroforestry systems of different types on the left of the screen. Compared to single crop systems, agroforestry systems deliver a number of environmental benefits at the farm level, such as improved soil fertility and structure, better habitat for native wildlife, and higher rates of carbon sequestration. Analysis of smallholder agroforestry coffee farms in Guatemala, for example, have found average sequestration rates of 2 metric tons of CO2 equivalent per year, and it can be much higher. With estimates or analysis by Per Projet, which is shown here, of over 100 metric tons per year. At a more landscape level, in areas with many coffee farms, we can see that this agroforestry mosaic emerges, which can help link otherwise fragmented forest reserves. And research has shown that should agroforestry production become unviable in coffee lands like Central and South America, the land would likely transition to less sustainable uses like extensive livestock. And of course, that's the key issue that we want to talk about today, which is viability or profitability for the farmer. Agroforestry production can support conservation goals, but to be truly sustainable, it must also support poverty alleviation goals. Otherwise, farmers will leave coffee for more quick wins like clear-cut timber. Of course, coffee farmers face many barriers to improving their livelihoods, and there's no one solution to fixing small-scale coffee production. So today I'm just going to talk about one piece of the puzzle, which is finance for tree replanting and how this type of finance can help build coffee farmer prosperity and support forest conservation objectives. So when I talk about renovation, which is the term used in the industry, I'm really talking about replanting aging coffee trees. So you can see a very simple diagram here, which just shows that you remove some of the older trees that are no longer productive, or perhaps trees that have been affected by disease, and you replace them with new coffee seedlings. You can either be talking about replanting an entire farm, an entire area, or infill planting, where you remove the non-productive trees and put in new trees sporadically throughout the farm. If we take a look at the economics of coffee farm replanting, it's important to remember that coffee is a perennial crop, but one with a defined productivity curve that you can see here in the top image. So to keep farms profitable, farmers should replace aging trees as their yields drop. Ideally, farms would include trees of various ages so that farmers only replace a small percentage of trees in any given year. Even so, the cost can be very significant for a poor farmer, between $5,000 and $12,000 per hectare in material and labor, depending on the context. Plus, as you'll see in the bottom half of the slide, farmers take a pretty significant hit to their cash flow in the short term because the new coffee trees won't produce coffee beans for several years. And smallholder farmers generally don't have savings to draw on, and so they need credit to invest in this type of initiative. But appropriate financial products are often not available in these rural communities. In brief, large commercial banks don't want to touch farm replanting generally due to the greater risk relative to investment opportunities in other industries. And microfinance institutions, which generally offer loans of several $100s or less, can't provide farmers with enough capital. The status quo is bad enough, but we're also seeing that climate change is exacerbating the replanting finance need. In Latin America, for example, a fungal disease called coffee leaf rust recently decimated coffee farms. Warmer, wetter conditions in Latin America spread the disease to farms never before affected. Farmers needed to replant much of their coffee, perhaps with more disease-tolerant or heat-tolerant varieties if they wanted to regain production. So Root Capital came into this as a lender in these communities. About 50% of our portfolio is in coffee, so this is a very serious concern for us. So to address this replanting need in the smallholder coffee communities in which we work, we launched what we call the Coffee Farmer Resilience Initiative. Working through coffee cooperatives or small traders, the initiative channeled long-term loans for replanting to coffee farmers, accompanied by technical assistance on replanting techniques and disease prevention. Here's roughly how it worked. Ultimately, we made 5 to 7 year loans to coffee enterprises, which the enterprise then broke up and redistributed to farmers through their internal credit systems, basically their in-house microfinance arms. We provided multi-million-dollar loans to businesses that became several $1,000 loans to individual farmers. Our loans were tailored to the replanting process, including a grace period of 3 years that allowed farmers and enterprises to defer repayment until the new coffee was generating income. But providing 5 to 7 year loans was new for us as primarily a short-term lender and riskier, so we didn't just jump into it, but rather built up to it. First, we worked within our portfolio of existing coffee borrowers. Long-term loans carry more risk, and so we wanted to work with businesses we knew well that had a good credit history with us. We continued to provide these borrowers with short-term working capital loans in the meantime so that they could keep operations running while waiting for the new trees to come online. Then we layered in business advisory to help businesses develop and manage renovation plans with their farmer suppliers. We helped them diagnose supplier need and develop renovation plans with participating suppliers. And then we also provided training on internal credit management to make sure that our borrower systems were capable of monitoring long-term loans to farmers. So that's the general approach. We can walk through a quick mini case of what this looked like in a particular setting. So this is data from an actual borrower that we have in Nicaragua. As you see, we've been working with this borrower, which is a coffee cooperative, for many years, since back in 2003. We were actually the first lender to this this cooperative, and you can see our first loan was quite small, $70,000. And since then, we've worked with the business basically every year, and we've helped that business grow significantly in terms of the amount of coffee that it can buy from its borrowers, or from its suppliers rather, and sell to its buyers. And with business growth, our loan size has grown as well to several $1 million today. So in this context, with this particular cooperative, on average, suppliers of the cooperative lost about 20% of their farms due to this leaf rust outbreak around 2012, 2013. So there was a pretty significant need for renovation or replanting across the cooperative. So we provided the cooperative with a $2 million long-term loan. It then just broke this up and dispersed it in smaller loan sizes to 400 members to finance the renovation of over 300 hectares of coffee land. In addition, we also provided the cooperative with some training and with also some grant support through a kind of sidecar vehicle that we call the Farmer Resilience Fund to hire additional agronomists whose basically sole responsibility would be to monitor renovation, help make sure that farmers are renovating successfully so that they will have coffee in several years, and help with reporting and basically loan collection in the field as well. Zooming out again, to date we've dispersed over $8 million in these types of long-term loans to 9 enterprises, reaching just shy of 900 farmers otherwise lacking access to this type of long-term finance. Based on modeling at the time of disbursement of these loans, we expected the credit and technical assistance package to boost farmer productivity and income by at least 25%, while increasing resilience to future disease outbreaks, which may become more frequent or more intense with climate change, particularly in Latin America. In terms of environmental impact, we expected to see at least 5 million coffee trees added to the landscape, as each hectare will have a density of somewhere between 3,000 to 4,500 coffee trees. So I'm sure many of you are wondering at this point about the return on these loans. We've talked about the potential value to farmers in the landscape, but how does the financing piece work? So I wanted to look at this question in 2 parts, the financial and what I'll call the impact returns. On the financial side, Root Capital generally does not earn commercial returns on these loans. Just come out and say it. The economics are in large part driven by the challenges of the markets we serve. Small deal sizes, high transaction costs, and higher risk relative to other sectors means loans to smallholder agricultural businesses generally generate negative to submarket returns once operational costs are factored in. This is true of our overall loan portfolio, and unfortunately the longer time frame of renovation loans makes them even riskier and therefore less likely to generate a risk-adjusted commercial return. So one might reasonably ask why Root Capital makes these loans if we don't always realize a profit. And the reason, of course, is for the impact. As I noted earlier, these loans generate significant social and environmental impacts for vulnerable communities, and they do so at a fraction of the cost of a grant. Basically, we can cover most, around 2/3, of the cost of our lending through interest rates and fees, and use a targeted grant to cover the gap. This is called a blended capital approach, mixing commercial and philanthropic capital to bring access to finance to challenging, underserved markets. And that's the approach we used in this case. We started with lending capital from investors, primarily corporates in the coffee sector, because they saw value in addressing this rust crisis and increasing production in their supply chains. We provided investors with a sub-market return on their dollars, somewhere around 2%. To protect Root Capital and our investors, we then secured first loss capital and loan guarantees to mitigate our risk exposure. These came primarily from USAID. We as a lender couldn't price the cost of risk over a 5 to 7 year time horizon into our loans. Our clients and their farmers simply wouldn't have been able to afford the resulting interest rates. So therefore, we had to seek alternative coverage in the form of first loss reserves and guarantees for any loans that maybe went bad. Finally, we brought in grant funding to cover the cost of the intensive business advisory I described. Together, this blended capital structure allowed us to provide a rich credit and advisory package to our borrowers in a way that did not unduly burden them while protecting their capital and our investors. So what did we learn from this experience? First, our push on renovation lending confirmed that there's a widespread need for investment and replanting among coffee smallholder communities. We knew this going in, but our field due diligence showed us that the need was greater than we realized, that more farmers needed to renovate and fewer farmers were in a position to take that investment on without credit. Subsequent research has confirmed what we've seen in our portfolio, estimating that over 50% of smallholder coffee farms across the world need renovation. It's a huge challenge. But we also learned to be careful of conflating need and demand. After the rust outbreak in Latin America, we found that many farmers and businesses simply weren't in a position to take on long-term debt to replant their farms. They needed several years of additional investment in their core businesses, building their sourcing capacity, professionalizing their systems, before they would be ready to manage an intensive and frankly risky long-term renovation program with hundreds of farmers. Which segues into our next lesson, that complicated on-farm investments like replanting really need to start with technical assistance, at least in smallholder communities. We realized we couldn't just disperse replanting loans. We had to first invest in building farmer and business capacity to develop and successfully execute renovation plans. So a year into our renovation lending push, we opted to defer some renovation loans, instead doubling down on short-term finance and on business advisory as precursors to future loans. In Central America and Mexico, for example, we provided over 80 days of training per business to help some clients prepare for future investment. So we had always planned to deliver TA as part of our renovation work. I showed it as part of our progression, but a key lesson for us was that we need to deliver more and over a more extended period of time than we had expected. And finally, a note on the opportunity of blended finance. I imagine the message that this type of lending, debt finance for underserved smallholder enterprises in emerging markets, requires a blended finance approach might be discouraging to some in the audience. But I wanted to share that I have a lot of optimism around this. First, because I think blended finance can help us move beyond the limiting dichotomy of finance as either purely commercial or purely philanthropic. We know that there's not enough philanthropy in the world to tackle conservation challenges. But we also know that investing in these vulnerable communities often delivers a mix of public and private goods. And so we need to look beyond that. We need to look to find where we can match incentives of public actors and private actors, and together bring market to bear to address these challenges. And I think we're starting to see that there's a lot of really positive momentum in this direction, particularly in the coffee sector, and I would say in the cocoa sector as well. And I think now there's really a question of who pays. When you do have this mix of public goods and private goods, what is the right blend of capital to achieve the impacts that we want to achieve? So I think there's encouraging conversations on this front in platforms like the Sustainable Coffee Challenge and Cocoa Livelihoods platform, but they're ongoing conversations, and we're going to have to see what falls out of those sector discussions. So with that, I will close, and I welcome questions, comments, and really look forward to the discussion. Thank you.
Great. Thank you so much for your presentation, Elizabeth. And we'll move into the discussion section now. And just as a reminder to all our listeners, you can type questions in the Q&A section of your screen, and I will direct them to Elizabeth. So first, I want to ask you, do you see this model applying to replanting credit for other tree crops? And kind of on a more high level, do you have any insight on how blending for agriculture differs from blending for other sectors like infrastructure, energy, or health?
Great, thanks. I definitely see that there there is a lot of possibility to apply this model to other tree crops. And I mentioned cocoa because there's actually a very active discussion about using blended finance models for cocoa replanting. There's similarly, excuse me, a very intense and widespread need for renovation investments across the cocoa sector. And again, it's kind of a problem that the corporates feel like they can't solve on their own. And governments in these countries like Ghana and Cote d'Ivoire also see that they can't solve on their own without a commercial involvement. So I think there is a lot of potential. Again, I think there's a lot of discussion, and it's hard to see, and a lot of pilots, a lot of good work happening at small scale. And the question is, how do we find opportunities to really scale investment in both of these supply chains? And then for the second part, insight on how blending for agriculture might differ from other sectors. We are an agricultural lender. We don't work in other sectors like infrastructure, energy, or health. So I'm going to kick that question down the road because I feel like I don't have the expertise to answer
that. That's a fair point. Thanks, Elizabeth. We have some listeners wondering how Root Capital evaluates cooperative credit. Is there some sort of standardized internal rating system that's used across all partner co-ops, or how does Root Capital address that?
Yeah, so we have a number of systems that we've developed internally to help us do our lending work in these communities. And so we really try to operate as much as possible like a bank. Perhaps a bank that's willing to go a little more the extra mile to really customize our products for our borrowers. But so we have our own due diligence processes, our own screening processes that we use in terms of developing pipeline and assessing pipeline for lending opportunities. And we also have various risk rating systems that say, okay, what is the likely risk of a loan to this enterprise, this cooperative, based on its management, based on its years of experience, based on its financial statements. And then we will use that risk rating across all lending opportunities to inform whether this is a no or a go or no-go decision for that particular borrower.
Great. So moving on, I know you touched on the issue of scale, but I'm wondering, does Root Capital anticipate a future in which the loans they provide are more profitable and scalable? And what systems or processes can be employed to minimize transaction costs across a portfolio of smaller loans?
This is a great question and something that we think about a lot. So I would say, first and foremost, we're pretty convinced we are operating subscale, which means that we just don't have the economies of scale yet that would help solve some of these issues around operational costs and profitability. So that's thing one. And then I think another thing that we have is an ongoing discussion too is, as I mentioned, we do try to operate with a lot of discipline and rigor around our processes, and in some ways we have adopted some processes that are used by bigger banks looking at different types of deals in more established markets, and some of those processes are very expensive. It takes a lot of staff time, or there's just a lot of process around that. And I think a question for us and other lenders in this space is, are there ways that we can make those systems smarter for us? Are there things that we can strip away that are unnecessary for our context, that we can be smarter around pipeline development or risk screening using some of these new tools that are coming out, particularly digital tools? And there's potentially a big opportunity there to reduce the transaction costs and therefore improve the economics of our loans. I'd say we're not quite there yet. I think there's some really promising innovations in the microfinance space in particular that might eventually make their way into the enterprise lending space. But yes, right now our economics is certainly a challenge that we deal with on a daily basis.
Yeah, no, that makes sense. And just a follow-up, I'm curious, can you just clarify what you mean by digital tools?
Yeah, so I think particularly in the microfinance space where you're looking at direct-to-farmer lending, there are some tools where, let me look more kind of at the back end of the loan, where they're using mobile payments, for example, to disperse the loans, to help with loan monitoring, to recollect the loan, rather than going through, kind of traditional banking sector and more of the infrastructure involved in that. There are also platforms that are trying to use digital surveys, SMS messages, things like that, to collect more information about farmer borrowers. And so that lenders have a better data set and can inform their decision making and potentially allow them to make faster decisions. So those are the types of innovations that we're seeing, again, more in the microfinance space, that could just reduce some of the friction in the system that we have now.
Great, thanks for that. So are you seeing any opportunities to bring in carbon finance to support this type of work?
Yeah, this is something I've also thought about a lot, because we are dealing in these tree crop systems where these farms are carbon sinks. They're actively sequestering carbon in many cases. What we've seen through talking with a lot of other organizations that work more in this space is that the carbon markets are still too unproven. The price signal isn't strongly there. And so that's a risk. And that also, when you're dealing with smallholder farms, dealing with 2 hectares here, 3 hectares there, even when you're working through a cooperative, often just the amount of the potential carbon credit value relative to the operational costs, again, of going to each farmer, doing the diagnostic, helping them improve their carbon footprint, registering the carbon credits, the economics just don't work out. The operational costs are just way too expensive. So we have seen with some of our clients, groups like Hevos and others have done some great work to bring some carbon credits to these farmers, but they've paid for the operational costs entirely through grant funding.
Great, thank you. We have some audience members wondering if you can share more about how Root Capital connects farmers with climate resilient varieties and how that might be able to improve returns. Like, do you foresee Root Capital's coffee portfolio shifting as coffee suitability becomes even lower in certain regions? In some cases, perhaps working with the same farmers to shift to different crops?
Yes, this is a big question. Another one part of my job is kind of R&D around climate and thinking about how we might better support our clients in this area. So this is something I think about a lot. I would say, so what we've done first, and this has been going on for the past couple of years, has really been trying to educate ourselves on what climate change might mean for coffee in particular in the regions in which we work. And so we have established partnerships with groups like CIAT, the International Center for Tropical Agriculture, with the World Coffee Research Group, with the Coffee and Climate Initiative of the Neumann Foundation, groups that are basically researchers that this is their specialty and have been trying to learn from them. And what we've seen so far is quite scary, that particularly in Central America, specialty Arabica coffee in many areas may be not viable, by 2030 or later. So right now we are engaged in, I'd say, still kind of the learning stage, and then we're starting to experiment with how we can better equip our clients with information about climate change and what's coming down the pike through our advisory arm first. So providing some trainings where we share this information that we've received from our technical colleagues at CIAT and other research institutions, trying to kind of translate that into the context of our cooperatives that we work with, and then help them think, okay, what are some initial things that you could do to start planning for this as part of the ongoing technical assistance that they provide to farmers. So it's very early days. I think there are definitely opportunities for improved varieties, heat tolerant, drought tolerant varieties, for example, and it's really exciting to see what World Coffee Research is doing there. I think there's also a big opportunity just for improved practices at the farm level, better soil management, things that will increase farmers' overall resilience to shocks, regardless of what particular shocks come their way.
Cool, thanks. So I'm curious what your thoughts are about making equity investments in your borrowers' companies.
Yeah, so basically, equity is a very different financial instrument, and so we started because we really saw this need in rural communities for working capital, for trade credit primarily to support their operations and help them grow, and that's what we developed our expertise around. So equity requires very different expertise, and it's something that we're just not set up to provide at this moment. I will say there's a huge need for equity in the borrowers that we work with, and I think in the impact investing space, there are a number of institutions out there that are increasingly providing equity or kind of venture philanthropy and a lot of really innovative financial instruments out there that are trying to address this problem, which is really encouraging.
Great, yeah, that's great to hear. So what is the potential role, if any, of securitization of small deals in diversifying risk or providing other benefits? Have you looked at securitizing these loans?
We haven't looked at securitizing these loans. One thing that is a little bit adjacent, we have seen a lot of interest from other lenders, including some very mainstream commercial lenders in loan participations, where we are effectively either they're coming in as a co-lender, or we are basically selling them a piece of the loan after the fact. And what's interesting is that some of these commercial players, they have a mandate to get more into impact investing. And so they're doing this because they want some of their capital to be going into these communities, but they don't necessarily have the back office, or really the front office in these cases. They don't have the boots on the ground. They don't have the expertise in sourcing these deals. And so that's been really exciting for us, and we've been growing our syndication and participation business pretty steadily over the past couple of years.
Great. Yeah, we have some listeners wondering if you can speak more about the model of lending through cooperatives or producer groups rather than small loans directly to small producers. Do you ever lend direct to individual producers?
Yeah, so what I say is just fundamentally they're different models. Yeah, they're different models, and you would be set up differently. I think where we see the power of our model is that by making one loan to one enterprise, we can reach many more farmers. So I said the average number of farmers working with one of our borrowers is 2,000. And so rather than making 2,000 small loans, we're able to make one loan and have that impact. I'd also say where we see the benefit of working through aggregators like cooperatives or processors or traders is that these businesses are often providing a really important service in terms of market connection. Not only market connection, but connection to better markets. A lot of certifications, for example, you can't be certified as an independent producer. You can't be, you can't be fair trade certified as an individual producer. It has to be through a cooperative or an enterprise. And so that gives you access to a higher price. And so we're seeing that not only does it allow us to reach more farmers, but these aggregation points are providing really important benefits to farmers in their communities, and we want to continue supporting those. On the flip side, there are some things where by working through the cooperatives, there's a limitation there that you wouldn't have if you were doing direct to farmer lending, particularly as we were talking about climate change, as we think about investment needs for changes in practices at the farm level, that might be very hard to do through a cooperative, whereas you could do it through a direct to farmer play. So I think it's kind of different instruments. The two instruments exist for a reason, and they are trying to accomplish slightly different things.
Yeah, thanks for that explanation. So specifically around, how you actually deliver these services, how many people, what kinds of expertise and teams, and what international operating arrangements are really needed to deliver these services?
Great. So globally, we have about 150 people in the organization. There's about 50 people in Cambridge, Massachusetts, which is our headquarters and our back office. And then we have about 8 other offices around the world, and those are our front offices, and that's where Our loan officers are based, our analysts, they're almost all exclusively nationals of the geographies in which they work in. And they're responsible for actually getting out into these communities, finding deals, doing the due diligence. And in certain offices, we have a fair amount of the kind of processing capacity there locally as well. And I'd say what's been really important for us, and something that I've really enjoyed as a Root Capital employee, is that we do have this very international staff, very local staff. And I think that's key when you're operating in these very different contexts. You know, lending in Kenya is going to look very different from Indonesia or Peru. And you really need Kenyans, Indonesians, Peruvians who can help you navigate that landscape and make it all work. And so I think that's been very important for us.
Cool. So you talked a bit about your investors and sources of capital, and some listeners are wondering if you can talk a little bit more about that. So we have questions coming in about who your primary limited partners are. So who are the LPs seeking out blended finance opportunities? You know, are they limited to philanthropic organizations and family offices with a philanthropic mandate, or are any traditional LPs starting to allocate capital to this? And then if you remember all of those questions, the final one is also, how do you structure the terms of the investments kind of made by the private sector investors?
Great, good questions. So we have about 250 investors who are investing, giving us our lending capital that I mentioned that we on lend. And again, it's a pretty diverse group. I would say, particularly in terms of kind of what is the profile of an investor. What's been really exciting over the almost 20 years that we've been in operation is that we are starting to see that more mainstream players are coming in. And so some of our investors are individual investors. They just have to be accredited investors, and so they are placing money with us, whereas they would before have been investing in other things. We also get a lot of investors through wealth management companies, wealth management officers, where they're working with a number of different investors who are saying, I want a portion of my capital to go towards impact, towards positive impact. I want it back. I want it to be an investment. I want to get a small ticket size, but I want some of my capital to go towards that. And so we work with a number of wealth management offices here in Boston, and also a lot on the West Coast. That's where we've had the most traction to date. It's kind of those two geographies, and that's really encouraging to see. And then we do certainly have foundations that are making program-related investments in us, so they're aligned with their impact, the impact objectives that they're serving through their philanthropic side. And essentially, we have a note that we offer our investors, and there's different notes for the amount of time that they want to have their capital with us, starting at 1 year and going up to several years. And our average cost of capital right now is, I believe, 2.2%. So, it's certainly below market, but it is, you are going to get that ticket back with your money.
Great, and good job remembering all of those questions. I want to move on. I'd be curious to hear kind of your thoughts on what are the barriers to scale for blended finance. It seems like by the nature of blended finance, deal size can be limited because they're proprietary, expensive to execute, and focused on a specific impact.
Yeah, I do think, I guess to me, the barriers are very much related to the barriers of the market challenge that you're trying to address. So it is going to look very different, as the questioner wrote, kind of based on the specific impact. You do need to have a financial product, including the blended finance structure, that is tailored to the finance need that you're providing and the impact that you're trying to have. And so that is certainly part of it. I would also say, for me, I think, particularly in smallholder agriculture, and this, I think, is really specific to this sector, there is often a mismatch of expectations in terms of what the returns are. So as a lender that's been operating in this space for a while, we see that the returns can be there in some cases, but even if they're going to be there, they're going to be small, at least if you're dealing with short-term debt in these communities. And sometimes it can be hard to find capital that even philanthropic or softer capital that is willing to accept those returns. So I think a lot of it is matching the capital supply to the capital demand, and I think that's really the conversation that's going on in coffee and cocoa right now. And then it gets even more complicated when, again, you're working at this intersection between public and private goods, where a coffee company is saying, why should I be solely responsible for the investment in these coffee communities when I'm partly solving for infrastructure issues that a government should be solving for, versus a government saying, why should I be taking on all of this when this coffee is going to make its way into someone's supply chain and provide a benefit to them. So those are the conversations that are happening right now.
Yeah, that's really great insight. We have one listener wondering what role does certification play in assisting co-ops to be credit ready, and is there any room for improvement here?
Yeah, I think about 60% of our portfolio is certified, and that number is much higher in coffee. So we definitely work a lot in the certified space. I would say certification can definitely help in a few ways. One, because there are a lot of requirements around management practices and reporting and all of these things, kind of the administrative part of certification, that can often be a proxy for the fact that this is a business that's capable of managing this external system, of collecting the information year in, year out that it needs, and reporting that to the certification auditor. And that is a positive thing to see, because those types of kind of business muscles are important for us as a lender as well. So I'd say that's one thing. I also think, it makes investors feel more comfortable, particularly impact investors, because there's a third-party check on some of the social and environmental issues that you care about. I think one thing where there's room for improvement, and I think the certification world would say this, is that there hasn't necessarily been the really transformative impacts in production practices, in productivity, in incomes that certification was hoping for. When this really started to take off, in the last 10 to 20 years. And so I think there's a recognition that there's more work to be done. I think there's certainly positive impacts that have come out of certification, but I think there's a lot of thought within the ICO community and others around, how can we have more impact, basically.
Mm-hmm. Yeah, that makes sense. We had one question. In terms of training community groups or farmer co-ops to navigate the loan process, what do these groups need to know? What skills or knowledge could help improve their success at managing loans and perhaps securing loans from additional lenders in the future?
Yeah, I think, so what skills are not? Yeah, I think it's a lot of it is kind of case by case. I think fundamentally there is still a big need for what I would say is fairly basic financial management skills. So one of the things that perhaps differentiates us a little bit and other impact investors, and also makes our work harder and more expensive, is that we often get financial statements from potential borrowers that are not up to snuff. And we will really work with them to make sure we understand the financial statements, make sure that they understand the financial statements. There's often a problem where they just kind of contract out the preparation of the financial statements and they have no idea really what it means or how to use that to inform their decision making. And so we do a lot of training around those types of issues, which are pretty basic, right? And so I think it is kind of going back to the ABCs of good business management. How do you set up a good accounting process? How do you develop financial statements? How do you use cash flow projections to better understand your business and plan? And so those are the issues that we provide the most training around.
Great. And then just one final question before we let you go. So how does Root Capital choose which countries to work in? It did not look like some of the major coffee producing countries such as Colombia and Brazil were shown on the map. So, are those countries targeted for the future, or is there a reason why, they're not a good fit for your model?
Mm-hmm. We do work in Colombia. We didn't do any renovation loans in this initiative, but we do work there. We do not work in Brazil. So I would say we started in Latin America, just because our founder and CEO had most depth of experience there, and we've kind of grown incrementally within Latin America, focusing on the Spanish-speaking countries, which excludes Brazil, and then over the years we've also moved to East Africa, West Africa, and Indonesia. So we're looking at a number of things when we go into a particular country. One, we are looking for a need for our type of service. In Brazil, for example, there is a much better functioning small business lending infrastructure with support from the government, and so there's not as much need for us. And in some countries, the regulatory environment is prohibitive for us to work. It would be too expensive, et cetera, and a lot of that has to come with is around regulations around moving USD in and out of a country. So that's the first thing. And then we look for a significant cluster of potential deals. And so again, we really focus on coffee, or then we look at industries that are kind of adjacent to that, like cocoa, like cashew, like macadamia nuts, other tree crops that are exported. And so that's how we've kind of mapped out our expansion over the years. We now work in about 30 countries in those 3 geographies.
Great. So unfortunately, we have run out of time, but we'd like to thank our speaker, Elizabeth Teague of Root Capital, for a really wonderful discussion. The recording of this webinar will be available on our YouTube and iTunes channels, so please check back for those later. Last but not least, be sure to check out the CBA website and newsletter for more information on upcoming webinars. And until next time, and on behalf of my co-host, Corey Skult, who is covering everything behind the scenes today, this was Amy Torget from the Yale Center for Business and the Environment. Have a great day.